I'm currently under contract for my third property, and I just went through the mortgage approval process, which can be a little bit lengthy and can seem pretty invasive. And I want to go over the actual steps to getting approved for a mortgage in this video. Because if you're looking to buy a property, whether it's as a primary residence or as a rental, again in your own name, where you're not using commercial style financing, but financing that specifically looks at your own personal finances, then this information is going to be pretty relevant. Because if you're looking to buy a property, whether it be as a primary residence or as a rental with your own name, not through some LLC or something like that, you are going to need to prepare quite a bit if you're trying to get a mortgage on that property. And a lot of those steps to actually get approved for a mortgage take place well before the actual buying process. It's a very long-term thing that you got to pay attention to if you're trying to buy a property at some point. But before I get into that, just want to introduce myself for anyone who's new to the channel. My name is Jack Duffley, and I'm a 24-year-old real estate investor and attorney. And in this channel, I cover a variety of topics as they relate to investing and personal finance. So if you like that sort of content, be sure to have a look around the channel. And if you like what you see, be sure to subscribe. For the purposes of this video, I'm going to be talking about personal financing for real estate. I'm not talking about commercial financing, which looks at the actual rent roll of the property. I'm talking about actually just getting approved based on your own personal finances, which is both a more straightforward and less straightforward process at the same time. And commercial style financing often has much worse terms compared to something like a 30-year fixed rate mortgage on a primary residence. Often that is going to be the best debt terms out there that you could possibly find in just about any industry. Now, one of the first steps you should probably take if you're looking to buy a house at some point in the future, even if we're talking about years down the line, is to actually start establishing a relationship or multiple relationships with loan officers and lenders. These are the people you can ask questions to about your personal situation and what you could reasonably get approved for based on your income, your credit, and all that. We'll get into those factors more specifically, but they are the gatekeepers to the loan system. If you want to get those great loan terms and those great interest rates, you're going to have to go through one of these people in just about every case. Some years back, when I was at the end of college and I had locked down a job for after graduation, I started talking with a loan officer since I knew I was going to be trying to get into a piece of real estate as quickly as possible, and ended up settling on this condo here in Chicago. I've talked about it at length on this channel. I used it as a house hack, but actually getting through the financing process was a little bit tricky since I didn't really have much credit history. However, my credit was clean, which brings me to the first point. Especially if you're new to the home buying process, my guess is you probably don't have a ton of credit history, and you want to get on that as quickly as possible, because probably the number one factor that lenders are going to look at is your credit score and your credit history. If you don't have any credit history, it's going to be very difficult to actually get approved for any sort of loan, because lenders want to see that you have some sort of track record in handling credit, whether that be credit cards, dealing with maybe student debt, dealing with other mortgages in the past. They want to see that you can handle debt. And your credit score tries to summarize those factors into one easy number. There are multiple credit rating agencies, and lenders will look at one or multiple of these credit scores that the agencies put out to actually get sort of a gauge on what your average score would be. Now, the big 5 factors that go into your credit score are your length of credit history, or how long you've had credit taken out, your actual payment history, and whether or not you've missed payments anytime recently. And by recently, I mean within the last few years. We're talking about a pretty long length of time, so you do not want to miss payments. Your third would be your actual utilization rate, which is how much credit you have taken out at any given time. You want this number to be lower generally if you're trying to boost your credit score. The fourth would be your credit mix, which is the different types of credit you have out there. The more variety in your credit, typically the better. However, this is a pretty small factor, all things considered. And then your fifth would be any hard inquiries that you've had on your credit. So if you've been doing a lot of hard pulls, you're applying for tons of credit cards, that's going to affect your score negatively, but only in the short term. And this will drop off typically after a year or two. But in general, those are the 5 factors that go into your credit score. And you want to pay attention to all of those. And the more you can do to help each one of those factors, the better. One of the simplest ways to get started with building credit is to actually take out a credit card, whether that be a secured card where you actually make a deposit so you can actually get approved for it, even if you have very little credit history and very little income. That's typically one way that people can do it. But if you can get approved for an unsecured card, which you should be able to do if you have a job and don't have any crazy credit history that's negative besides that, you should be able to get started that way too. That's how I got started. I had a part-time job in college, and I was able to get approved for an unsecured credit card through Bank of America. Got a nice sign-up bonus as well. There are lots of options out there, but the point is you want to get started as quickly as possible because length of credit history is a big factor, and you want to have as much length as possible before you actually go applying for mortgages, because typically the score you're going to need to get the best terms on a mortgage is something like a 740. If your score is over over 740, it shouldn't limit you in any way in getting the best interest rates and the best terms on a mortgage. But in sum, take care of your credit and get your credit score as high as possible before you end up applying for mortgages. And just a quick tip, definitely don't apply for any new credit right before you're actually trying to apply for a mortgage. Typically, we're talking about 6 months maybe. Talk with the loan officer. They'll give you some advice on what to actually do, because after all, this video is not financial advice. But don't apply for new credit before that, because you want your credit to be totally pristine. You don't want to show the lender that you're out looking for tons of different credit cards and are adding risk to your credit profile. They don't like that. They want to see that you are a stable, great candidate to take on a hefty mortgage. And fast forwarding, after you get approved, definitely don't apply for any new credit. Don't go get a car loan. Don't get a new credit card before you close on the property that you're trying to close on, because that would potentially throw a wrench into the entire underwriting process, and a lender is not going to be very happy about that, and that could totally kill the deal. But moving on to the next factor, that would be your income. This one is going to be a lot more variable since there's lots of different ways to make money. Typically, the easiest way to get approved for a loan would be through a W-2 salary job, something very quote-unquote stable that has a guaranteed pay level so that you're making the same amount of money each month. Lenders can take a look at that salary and be like, okay, you can get approved for this amount of loan because we know you're going to be making this much based on that salary. However, you still might run into a roadblock there, because if you're switching careers or there's something strange with your actual income history, the lender might want to see 2 years of stable income within the particular career that you're in. So if you just switch jobs all of a sudden into something wildly different than what you're doing before, they might not actually count that previous year of income, and they're going to discount it appropriately against you. However, one interesting wrinkle in the mortgage system is if you actually go and get a degree and then work a job right after that, a W-2 job or a salaried job, then you actually won't need actual income history prior to that. They're just going to say you were in school and you got a job in the career that you studied for or something like that, and therefore we don't really need to look at any previous income history because you were studying to get this job in the first place. So it's almost like you get a head start. You don't actually need more income history prior to that. That's how I got a mortgage in my first year out of school, because all my lender needed to see was that I was in school the previous year, I got my degree, and then I ended up working a job right after that. So that was all they needed to see. Same thing went for getting my law degree. I had very limited part-time income prior to this year. Now I'm working full-time now that I have my law degree, and they were able to just kind of ignore everything prior to me starting my full-time job because I was in school. Again, definitely talk to a loan officer if that's something you're interested in doing. If you happen to be in school and you want to invest in real estate right after it using something like a W-2 salary, that can be something you can do. You don't need to build up 2 years of income history necessarily because of an option like that. But if you're not in that camp, or if you're a 1099 worker, you're self-employed, you're a contractor, and you don't have as quote-unquote stable income like a W-2, then you're typically going to have multiple years of income history to actually get approved. They're usually going to take something like the average of the previous 2 years and use that as your average income, and that's what they're going to project when they actually do their underwriting. And the magic number that most loan programs are going to go for is something like a 45% debt to income ratio, meaning that once you take on the mortgage, the mortgage payments and taxes and insurance can't be more than 45% of your monthly income. So that's why your income matters so much, because it directly determines the amount of loan that you can actually get approved for, which obviously makes sense. Banks generally are not in the business of giving people too much debt to where then they will need to foreclose on that property because they are not made to do property management. That's very expensive. They want you to just pay them back with interest. Really, what most lenders want to do is they'll lend you the loan, then they'll immediately sell that loan to either the government or to some pension fund, or to the government, who will then sell it to a pension fund after that. So really, your loan doesn't stay in the bank's hand in many cases. But in any event, they don't want to give you too much loan because they don't want you to default, and often there's very strict regulations tied to it as well. Now, your credit history and your income history are the two biggest factors that you got to focus on in trying to get approved for a loan. And this typically comes in the years before you're actually shopping for a property. But as you get closer to actually trying to get approved for a mortgage, you're going to still need a couple more things. One of those things is saving up for a down payment and also reserves. Typically, they're going to ask for something like 6 months of the mortgage payment amount to be saved up as well as a sort of reserve account. So you're obviously going to need the down payment since you're trying to buy the property. You got to put some money up, but they also typically want you to have some sort of reserve. So you're going to have to save up for that. And depending on how much money you make and how much money you can save, that can take a while. So be ready to do that. And assuming all of that checks out, this is when you can ask for what's called a pre-approval letter or a pre-qualification, where the lender will give you some sort of document saying that you've been approved for X loan amount, and therefore therefore you can use that when you're making offers on properties. You can attach your pre-approval letter, and all of a sudden you look like a much better buyer. You're a prepared buyer, you have proof of funds or proof of ability to get financing, and that's going to make your offer stand out a lot more from someone who might not have that. And in many cases, listing agents won't even accept offers that don't have some sort of proof of funds or pre-approval letters, since that is the key to any deal. You got to put up the money somehow. But from there, assuming you get an offer accepted and you go what's called under contract, where you are the next in line buyer, assuming the actual deal goes through, you have that right to take a look at the property or whatever the contract says. But assuming that happens, you're still going to need a few things from the lender, but the biggest one probably being the appraisal. This is where the lender will send out some sort of appraisal company or an appraiser to take a look at the property and say what they think it's worth. It's kind of an arbitrary system if you ask me, but they want to get a second pair of eyes on the property to sort of make sure that you're not wildly overpaying for it, so that if the bank actually forecloses on the property, they'll be more confident that they could sell it back for at least what they lent it for, and that they're not paying for the premium that you paid for the property in the first place. So you want this appraisal to be at or above whatever your offer price was, and as long as that happens, then you should be able to get through to the end of the actual underwriting and closing process for the loan. This again happens after you actually get the property under contract and the lender is doing all of their due diligence work. But really, a lot of the heavy lifting comes well before actually applying for a mortgage. It's building up credit history. It's building up income history. It's saving up for that down payment. That's what takes the longest amount of time. And that's what you got to prepare for. So the higher you can get those things, the higher your income, of course, the higher your credit score, the higher your down payment and reserve account, the better for actually getting approved for a mortgage. When you actually go to apply for the loan, the lender is going to ask for all sorts of documents so that they could verify those things. So they could verify that you have the savings. They're going to ask for bank statements typically. They're going to verify that you have that income. They're going to ask for maybe tax returns or your W-2, or maybe a verification of employment as well. They're definitely going to do that if you're a W-2 employee especially. They're also going to look at your credit score. They're going to pull your credit, run your credit report. So they're going to look at all of this stuff, and you should just cooperate, hand them the documents they need, and they will look at them to see if you can actually get approved for the loan. Because remember, the bank is your friend. They're the ones giving you the money to actually buy this property. So treat them well. Make things as easy as possible for them. Do the hard work beforehand in boosting your income, boosting your credit score, so that when it comes time to actually applying for the mortgage, it's a lot easier to actually go through that process. But otherwise, that's all I've got for today. So if you like this video, please like it, since that would help the channel out a lot. And if you like this sort of content about investing and personal finance, and I do a lot of real estate content as well, be sure to subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. And check out the free stuff and the affiliate links in the description below. But until next time, take care.